I'm excited to get into this next part because I want to start talking about cap rates a little bit, if you don't mind. We know extremely important and crucial indicator when analyzing a multifamily deal is the cap rate. So maybe you could take a few moments in detail and explain what is a cap rate and how it affects the underwriting process.
Yeah. So what I do love talking about cap rates because they are so simple yet so complicated. And the reason why is because the formula itself is quite simple, and it's one of the first things you learn when investing in real estate because it's one of the most fundamental measures of return potential. And so for those that are unfamiliar, a cap rate is simply your income divided by your purchase price or your value. So it's just those two things. Very simple. But the reason why it gets complicated is because we start digging in deeper and we ask, well, what income? Is it the past 12 months income? Is it the future 12 months income? And is it adjusted for certain, expense adjustments that you may need to make? And then on the value side, I would say it's probably a little more straightforward. You've got your only options for value are your purchase price, or you can add on your renovations. So, for example, I'll just give an example to make sure that you value things properly. If we're going to look at, let's say, a cap rate type of equation, and we're going to look at what the future income potential is of the property, because we're less concerned with the current income oftentimes because we're looking at the future, at the business plan to get us to a future income. Now, if I take my future income and I divide it by just my purchase price, I'm going to get an unfair measure of yield because I didn't include the costs associated of my business plan. Because if my business plan included a $2 million renovation budget so that I could increase rents and get a higher income, I need to factor that into my cap rate equation. So it needs to be future income divided by purchase price plus my capital expenditures to get a more honest and fair evaluation of my return potential. So it's always making sure that you're comparing apples to apples and calculate everything. Another thing that is kind of interesting is you hear there's kind of two schools of thought, and there's like an old school real estate investor, which all they care about is the cap rate, the historical cap rate. And they just look at the numbers as they are and say, well, if the cap rate's not there, I don't like it. And then you've got kind of a newer school of investor that says, I don't even care what the in-place cap rate is because I know I'm going to raise rents and run my business plan, and that's how I'm going to get my return. And the real answer is somewhere in the middle. Neither approach is correct. It does absolutely matter what your going in cap rate is, but it also matters what your business plan is and how far you can push the cap rate. So you have to balance both.